All right, so Pablo and I are just sitting out here enjoying a nice morning, and Pablo says, Dad, tell me how it is that AMD has a price that has a PE ratio of 160, doesn't have a yield, thus it has no dividend at all, but the PE is 160, and over the last 3 years has gone through the roof. I think its trading has gone about, quadruple performance over the last 3 years or something like that. Whereas Intel has a PE of 9, just 9, that's it. Over the last 3 years, you all right there, buddy? Over the last 3 years, it has done nothing. So would AMD be a description of a growth stock and Intel the description of a value stock, says Pablo. What do you think, Pablo? I don't know how you buy AMD if you're looking at semiconductors. I have no clue I was just talking to a guy right now, my man in Texas, tell me about 7 nanometers and 5 nanometers and all this stuff. I have no clue how it works. I mean, he was giving me a background of it, but so if I'm buying a stock, you have to buy it as, where do I think that stock's going to be 5 years from now? Like, why would you buy it otherwise? You can day trade, that's dumb. But anyway, he was telling me his wife bought AMD back when basically no one wanted to touch the 10-foot pole. It basically went flat for 3 years, but she had the patience. She stuck with it, and then it had a pop over the last, basically a huge pop the last few months, or last year or something like that, but certainly over the last couple of years, it had a big pop. And that's the way you do it. You sit there and say, I'm going to buy a stock for whatever reason, and I'm just going to sit it out, wait it out. And the stock's going to do one of 3 things. It's going to go up, it's going to go down, or it's going to go sideways. Which is why, in my opinion, you always want dividend stocks, because if it goes sideways, you're still gathering the dividends. You see what I'm saying? You're not just waiting for the price to appreciate. You're waiting for the dividends to kick and buy more shares. So if you got 100 shares that pays a 2% dividend, you're getting $2 a share. So inherently, you just added $200 to your I wouldn't say a profit, but you just add $200 to your cost basis, and you can figure out how many shares you just added. And so basically, you're saying I just added $200 worth of shares to my holdings by doing nothing. So even if the price doesn't do anything, sorry about my hair, I haven't showered yet. Even if the price doesn't do anything, the dividends are still adding to the number of shares that you have. I hope that makes sense. So the stock goes up, goes down, goes sideways. That's it. Those 3 things. If it goes down, it sucks. It'll go down less if you have more shares because of dividend reinvestments. What I mean by that is, as each share builds another share, if it goes down 20%, it goes down 20% on more shares that you have, if that makes sense. So it's less of a pain point to you because you initially had 100 shares, now you have 105 shares. From a share perspective, it's not nearly as painful as it is if you didn't reinvest in dividends or had no dividends at all. If it goes sideways, the dividends help. If it goes up, both sides are doing well, that's for sure. So one of those 3 things. So I'm sitting there thinking, okay, if I was to buy AMD versus Intel, and this is where investing, this is why I don't understand why they use these high PE ratios, the CAPE, cyclically adjusted PE. I'm going to talk about that in a different video. I don't have time to do it right now because I got another call to take here in just a second. Anyway, I'm going to do another video on the error, which I have just learned. I did not know this. I just learned this yesterday, and I tell you, I've been sitting out coronavirus for 4 hours reading various articles about the flaws that investment researchers have made, including Noble Warriors. And I'm going to share that with you because it's mind-stakingly obvious when someone points it out to you. You're like, ooh, I didn't think about that. Anyway, so going back, if I'm sitting there and I'm looking at a stock and I'm looking at, you always got to look at the alternatives. All right, so this is where it goes to PE ratios with stocks versus bonds. Stocks, bonds, real estate are essentially the biggest alternatives there are to investing. The other alternative would be paying down debt. So there's 4 ways essentially to deploy your cash that most people will consider. Stocks, bonds, real estate, paying off debt. All right, real estate ain't cheap, that's for sure. Real estate ain't cheap, we know that for a fact. So you can go buy more real estate, but you're buying at a pretty significant price relative to where it was 5, 6, 7, 8, 10 years ago. Bonds are incredibly expensive. That's why the yields are so low. All right, Pablo? Don't forget, when Pablo appears, you got to paw the like button, paw the like button. I thought you had to go potty. Ooh, I just got a mosquito bug on him. I killed that mosquito. Yes, I did. Get off, Pablo mosquito. So bonds are incredibly expensive, thus the yields are so low. Stocks are expensive relative to historical norms, but I don't think they're expensive at all relative to bonds and or real estate in particular. Now, are stocks expensive relative to paying down debt? Yes, I do believe that. So if you have some debt, you should pay some off, but you still need stocks. When I say stocks, I'm talking ETFs and mutual funds. I'm not talking individual stocks. Classic Pablo. Anyway, I'm talking broad-based investments. Stocks are cheap relative to real estate. Probably cheap, but certainly cheap relative to bonds. And then you go into classifications of stocks. Intel with a PE of 9 is a hell of a lot cheaper than AMD with a PE of, like I said, I think it's 130, 160 or something like that. Is Intel down and out where it's going to go bankrupt? Not with a PE ratio of 9. Now, I have no idea what the debt is. I just don't know. I have no idea what the return on investment is, no idea what the ROA is, no idea what the price to book is, no idea what their debt servicing is. I have no idea. But just from the basic perspective, has been flat on his back for 3 years. AMD has gone up like a crazy man. Intel's got 9 PE, is still paying a pretty hefty dividend with a dividend yield of over 2%. And AMD has got none of that. I'm just sitting there, why would you buy AMD over Intel? Yeah, I wouldn't. I wouldn't touch a 10-foot pole. AMD. Well, because see, that's the thing with price to earnings ratios. The PE is already forecasting. Well, don't you see, Josh, that it's like going back to Tesla. Don't you see, Josh, that the value is in the future performance and what they're going to do in the future? But it's already priced into there. That's why the PE is so high. Yeah, just some food for thought. Love to hear your comments. Thanks.